Threshold criteria. Should you open your wallet at all? What if I told you to buy a stock that cost $100, where the underlying company has an annual free cash flow of $1 per share, 1% of the stock price, and pays a dividend of 50 cents per share, 0.5% of the stock price? To make things worse, the firm is continuously issuing new shares to further enrich its managers and finance their empire-building obsession, while still not producing any more money in spite of the growing company size. You should say I'm crazy enough to be locked up in a dark room alone, and surely not allowed to share my views on investing at all. I've just described a major difference between the absolute and relative aspects of valuation. This needs to be discussed a bit more before we move on to some very important criteria of stock selection. For the sake of illustration, imagine that you're a very stubborn and simple-minded investor who's only interested in the stocks of dividend champions, companies with at least 25 straight years of higher dividends. So this is the well-defined group of your targets, and you simply rank this group of stocks based on their dividend yield. The higher the better. Again, this would be foolish, but as simple as this example is, it'll help us highlight something very important. Think about this approach for a while, and you should agree that regardless of the prevailing market environment, you can always rank your chosen stocks, the champions, in the order of dividend yield they provide. There will always be a highest yielding dividend champion, a second highest, and a lowest as well. This is a relative ranking. You can produce this at any moment in time to see which stocks on your target list offer the best value. In this case, you only measure value by the dividend yield. But notice that this does not mean the best placed stocks in the ranking are always worth buying. In times of market panic, stock prices get hammered, and the dividend yield offered by champions rises. This is when you can easily go for the top of the ranking companies. But what happens when the other extreme strikes? At times of euphoria, stock prices get inflated, and dividend yields can drop to irrationally suppressed levels. Imagine an extreme situation in which you do your ranking of champions only to see that even the top 10 only offer dividend yields below 1%. These are at the top of your well-established stock-picking system. So, should you go out and buy them? From the dark room where you've got me locked up, I'm yelling as loud as I can, no. This is where some absolute criteria should come into play. We need to define certain thresholds where the failure to step over them absolutely disqualifies a stock, regardless of its place in the relative ranking. After all, if an investment opportunity can't offer decent prospects, you should keep your wallet shut and wait for better times to allocate your capital. This step in the FALCON method is all about defining those threshold criteria that should be met before any money goes out for investment. There are 3 things you should know before we proceed. 1. The indicators I picked are widely used ones, which have quantitative proof of being attached to superior stock performance. On top of this, they're all reasonable, so it's easy to understand why they're important. 2. I deliberately define low limits with all 3 indicators, since my experience shows that needing to meet all 3 low requirements at the same time usually disqualifies a very large chunk of stocks on our list, but leaves just enough of them to continue the analysis. So this is really a very tough combined filter despite seeming to be a bit lenient on the individual factors. 3. You cannot fix all the limits as absolute values for the rest of your life. This is why I'll not disclose the current levels in this book. Please understand that the same dividend yield that looks attractive in a market environment when 10-year U.S. Treasuries yield below 2% can look ugly when risk-free rates approach 10%, so you should adjust your requirements accordingly. I'm using this extreme example on purpose, just to make you think about and accept that your absolute criteria cannot be totally independent of the prevailing market conditions. Well, unless you're prepared to wait on the sidelines without investing for decades, speculating on certain macroeconomic developments, which is an approach no reputable value investor advocates.